Welcome to the last session of the innovation stage. Thank you all for coming. We had 2 great days of presentations. My name is Patrick Mirza. I'm the Communications Director for the ESOP Association. We thank you for coming to Employee Owned 2019 and for attending our sessions here at the innovation stage. The last session today, we're going to talk about cyber liability and fiduciary liability insurance. We're going to hear from Jeff Gelberd and Patrick Dixon from Murray Securus and Ryan Fitzsimmons from
Great American.
Great American. Thank you very much. Take it away.
Thank you, Patrick. Good morning. We're honored to have Ryan here from Great American Insurance Company, and Ryan heads up the cyber liability insurance division of the company. So I guess an appropriate first question here this morning, really, Ryan, with respect to cyber liability insurance, I know there's two main parts of the coverage. And just for our viewers and listeners, if you can describe those 2 parts of the cyber insurance policy for us.
Sure. Cyber risk insurance has come a long ways since the early days of Y2K types of exposures that focus primarily on business interruption. Right now, most cyber risk policies are offering between a basket, I'll call them, of 8 to 10 different coverages. Mm-hmm. Some of those coverages are liability in nature, where we're insuring the financial loss that the insured might be responsible for failing to protect somebody's information. There's a media risk component to the coverage as well, some liability coverage there. There's also a regulatory element to the coverage on the liability side of things. But I think the things that most buyers relate to the most readily these days reside on the first party side of the policy. And the first party side of the policy, in insurance jargon, first party covers the insured's own expenses related to whatever event it is that they're dealing with. And in the cyber liability world, we're dealing primarily with events related to privacy incidents, the exposure of information that you shouldn't expose, security incidents, you're under attack or transmitting a piece of malware somewhere where you shouldn't be, or a media incident, kind of like we talked about before. There's also kind of a crime incident component to the coverage as well, where the company's credentials are stolen or business email is compromised, and so therefore the insured winds up with a lot of expenses related to dealing with those sorts of incidents. And it really primarily, I think, on the first party side, what folks are buying more than anything is forensics expertise. So there's 6, 7, 8 coverages on that first party side. Business interruption, some forensics coverage, notification, credit monitoring, data restoration, coverage for extortion events. But if you think about a traditional liability insurance policy, for example, one of the biggest things you're buying is the cost of defense, right? Even in the fiduciary liability insurance world, a lot of times the most significant expenditures are related to the attorneys. Surprise, surprise.
Exactly.
On the first party side of the cyber policy, there are some legal expenses involved because you're dealing with data breach coaches that provide legal guidance in terms of what the company's compliance burden might be. But the professionals that are, and they're kind of quarterbacking it, right? But the offensive line of the cyber risk response, that's really the forensics experts. And that's a significant piece of the overall coverage, because whether or not you're talking about a ransomware event where somebody's network has been encrypted and they're being asked for 5 Bitcoins to unlock the network, or whether or not you're talking about a data breach or any other myriad of events, forensics experts come in and help the insured understand how did they get in, what did they get their hands on, are they still there, and then depending on the size of the company's, I'll call it digital footprint. These would be the number of devices, the number of IP addresses, that kind of thing. Depending on the size of the company's digital footprint, that forensics investigation can go on for weeks. And those amounts can run easily into the 6 figures and often into the 7 figures, depending on the size of the organization and the magnitude of the incident that's taking place. So I think that's the piece of the first party side people relate to the most readily. So
Right.
you're right, two buckets of coverage,
Right.
liability and first party, but that first party piece is really, oriented around. Many of insureds are overwhelmed in the event that something takes place. They
Yes.
lock up the network, you can't do your business,
Right,
right? And then
right.
that forensics piece is oftentimes the most critical element of getting the insured back on its feet and through the incident. And that relates to almost every element of that first party coverage.
Yeah, good. Now, I know as Patrick and I, as an insurance brokers, when we're talking to the client, one of the things that we stress is it's not only about the insurance protection, but it's about the services that are provided by the insurance company, whether it's services before a claim happens or services after a claim happens. So you mentioned about the forensic. What other services can an insured find with the Great American policy?
Well, it's almost not even necessarily unique to the Great American policy. Insurers are increasingly in the cyber risk space offering, I'll call them, a suite of value-added services that policyholders avail themselves of. Some of it is as simple as, content, education, training, RSS feeds, blogs, educational material where people can go and orient themselves around what is a network security program look like? What's an employee awareness program look like?
Right.
Who are some of the bigger vendors in the space? So on the pre-breach side of things, pre-incident, pre-breach, however you want to think of it, before you have a claim, we're very interested, the industry in general is very interested in making sure that insureds get resources that help prevent losses, right? It's not any different than fire prevention or suppression systems
Right.
and that kind of thing in other lines of insurance.
Right.
We make those same recommendations on the front end to help our policyholders be more informed, more prepared, in hopes that they don't have a claim.
Correct.
But then there's the post-breach side of the incident response, and that's really the claims handling process that the insureds are really, really buying is once somebody's in my network and have encrypted it, or once we've been informed by the FBI that our customers' credit card numbers are showing up on portals in the dark web, what do we do? Where do we even start?
Right.
And oftentimes that starts with a breach coach. So there are data breach statutes in virtually every state.
Right.
Some of them have been amended very recently.
And they
So
differ.
there are lawyers who specialize in. I mean, there's a whole cottage industry mushrooming up around cyber risk.
Right.
Many of the vendors in the space are data breach coaches. They know the law. They know what the obligations are. They know the forensics experts. They know the security firms. They quarterback your response. So a lot of times on the post-breach or post-incident side, really on the claims response side, you've got the claims adjuster at the insurance company intimately involved and a breach coach intimately involved, and that person's kind of quarterbacking the response. And then that myriad of vendors he or she is working with differs depending on the type of situation you're in, right? So if you're a healthcare organization and you're dealing with the exposure of protected health information, you're going to get somebody with significant expertise in the HIPAA space.
Right.
If you're dealing with credit card information, maybe you're a retailer or an online store, you're going to be dealing with primarily somebody in the payment card industry or PCI DSS.
Right.
Try not to use acronyms in these presentations, but the payment card industry data security standard is a lot of times what the insured is held accountable to in terms of credit card related breaches. So there's a whole cottage industry surrounding PCI compliance and that kind of thing as well. And so the carrier and the breach coach work together to make all of those services available to the insured in the event of a claim. And many times we're prearranging those services because we buy them in bulk. We deal with claims. The industry deals with claims, day in, day out. The insureds do not. We get a better rate, quite frankly, than the rack rate one of our policyholders is going to get if they go to a vendor in crisis, right? So we line all of that up in advance and have panels that are sort of selectable, and the insured and the breach coach and the insurer work together to select the most appropriate vendors from that panel to put together a response that's going to get the insured back on their feet as quickly as possible.
Yeah, good.
Just how important is early notification with the breach coach?
Oh, critically important. So, we were talking earlier about the myriad of different data breach laws. Some attorneys general require to be notified in some of those circumstances, right? Many of them do. And oftentimes, if you're delaying things or not being forthcoming with consumers, particularly in the space where you're dealing with consumers, B2B is one thing, but business to consumer is another. In the consumer space, if you're not being forthcoming about information, if you're not handling things in a timely fashion, oftentimes the attorneys general or whoever it is that's involved is a little bit more sort of penal in nature, if you're not forthcoming. But time is of the essence in many of these circumstances, whether or not it's a data breach or an encryption event or whatever might be happening. It's very much the insured's or the insurer's responsibility, I'll say, to make sure that we're advancing the ball as quickly as we can. But we can't start that process until you bring us into the equation, right? And I think there's a temptation on behalf of the policyholder a lot of times to not involve their insurance company right away because maybe they can fix it themselves, or the IT guy knows that something's taking place and it's going to be a big problem for him if everybody else finds that out. And so there's this, I think, sort of, this response where you want to handle it quietly without the insurance company involved. And oftentimes you make things worse. Either you tick off an attorney general because you weren't forthcoming with consumers, or you tick off the criminals. They're oftentimes, they're starting a countdown clock. Give us 5 Bitcoins in 5 days. And if you can't get your act together and pay it, it's going to 7.5. And so time is of the essence in this response. And the quicker the insurer is engaged, the faster our network of vendors is mobilized. Oftentimes, the less money the insured is going to be on the hook for, the less reputational harm the insured is going to suffer, and quite frankly, the faster they're back up on their feet. So time is of the essence in these responses, which I think there was a lack of appreciation for that 3-4 years ago. Increasingly, I think people are becoming more willing to engage their insurers more readily and mobilize that network faster. It's a critical piece of the response.
No, I agree. I agree. We were talking earlier this morning about social engineering, and social engineering I would define as being a loss where there's an email that's rampant email that comes in that you think is from the CEO to the CFO asking to wire money to a bank, and you find out that that wasn't from the CEO, but it was from an outsider to wire money to a bank in some foreign land. So cyber policies are evolving, and now we can get the social engineering coverage on the cyber policy, whereas before it was just primarily a crime policy type of coverage. What is your recommendation usually on where to find or where best to have the social engineering coverage?
So I think that cyber risk insurance has always dealt with the theft of data. Right, and crime policies have always dealt with the theft of money and securities.
Right.
So I think everyone's instinct is instantly to say it belongs on a crime policy because it's a money and securities related type of situation. Many crime insurers have, for years offered social engineering somewhat reluctantly. Right, you're dealing with what crime underwriters refer to as the voluntary parting of funds.
Yes.
In an electronic funds transfer fraud type of scenario, your typical crime claim, there's no human involvement. One machine is hacked, it sends a different routing number, a different account number, different instructions to the financial institution, and that's how the money changes hands. Those have been covered very well by crime products since the beginning of time, right?
Yep.
Once you introduce the human element and somebody is quote unquote tricked or deceived into voluntarily transferring funds, crime underwriters weren't very excited about taking on that exposure when those events started taking place, right? Because on some level it's very difficult. We like to say in the industry, it's hard to underwrite stupidity, right? So, oops, I got tricked. I sent $600,000 to a Chinese bank that we've never dealt with, right? So that's a very difficult event for folks to deal with. Cyber risk underwriters stepped into that void. Crime underwriters were uncomfortable with it. Cyber was a growing product. They wanted to give folks reasons to come to the cyber underwriting desk instead of the crime desk. Voila, social engineering on a cyber risk form, right? There's a primary difference right now in the cyber risk insurance world versus the crime world. Many crime underwriters are offering social engineering coverages with what we call in the industry condition precedent to coverage. You have to do something in order for the claim to be covered. And in the social engineering world, that's a callback procedure. So somebody calls and asks you to transfer money, or somebody emails you and asks you, I'm the CEO, you're the CFO, you get an email from me, not really me, asking you to send money, right? So the callback procedure is you pick up the phone and call me. And we have a discussion about whether or not I sent you instructions to have $600,000 wired to China, right?
So I send you $600,000. How much coverage would I have on my policy to say cover that eventuality?
Many of those coverages are sublimited, but in the crime world, if you didn't make the callback, you don't have any coverage because it's a condition precedent to coverage, right? So in the cyber risk insurance world, many of the policies don't involve the condition precedent to coverage, but instead they involve sort of underwriting on the front end, where cyber underwriters are asking the agent or the insured on the front end, do you have a callback procedure? It's amazing what the callback procedure can avoid, right? It's a very, very effective, very, very simple tool to avoid huge losses.
That's an important distinction, the callback feature.
Yeah, so that callback precedent to coverage doesn't exist for the most part in cyber products.
Right.
Cyber underwriters ask those questions on the front end. If the insured's got a callback procedure, they'll issue the coverage. There's certainly an additional premium associated with it. There's oftentimes a sublimit associated with it. Many crime underwriters are probably willing to put up higher limits than cyber underwriters are willing to put up. Cyber underwriters probably put up $100,000 or $250,000 worth of social engineering coverage. Crime underwriters have historically offered more than that, $1 million policies, but their policies are a little tighter, right? That condition precedent to coverage is huge because the first question that the claims adjuster asks is, did you call me back? Did you call him back? And if the answer is no, there's no coverage on a crime form, right? So
that's important.
Important distinction. Yeah.
And kind of what headwinds do you see on the horizon in terms of writing cyber insurance?
We're seeing it. I mean, right now it appears to us brokers that there's a number of insurance companies now offering cyber insurance, and that the rating, the premiums are pretty stable, and the coverages are evolving and getting better. I mean, but we're seeing also increased activity of events, and is that going to at some point have an impact on availability and the pricing of the cyber insurance product?
Absolutely. So cyber's in its infancy in the grand scheme of things, right? 20-year-old product or so. Certainly in its infancy relative to other insurance lines.
Right.
We've been through several market cycles already in the cyber insurance space. Things have hardened considerably and then softened considerably a couple of different times. Everybody remembers the Target, Home Depot, and Chase breaches that kind of happened bang, 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 one after another. The market got sort of very hard after that. But then again, we've had a lot of entrants to the market over time, and so things have softened. You're probably right that they've leveled out a little bit now. I think the market is somewhat bifurcated, if you will. You've got a lot of carriers that are interested in larger risks that are purchasing a $100 million tower of cyber risk insurance. Pricing there is still pretty firm. These are big exposures, and not a ton of carriers willing to take on or put up, $10 million or $25 million on Chase Bank or something like that. But then you enter the middle market space, probably where the majority of ESOP clients reside, and there are a lot of MGAs, Lloyd's facilities, traditional markets, specialty markets. So there's a lot of capacity in that kind of small middle market enterprise space, maybe under $500 million in revenues, under $250 million in revenues. A lot of capacity there, a lot of competition. Rates are probably not as firm there as maybe they are in the higher limit world.
And now, how standardized are all the different policies? From our perspective, social engineering is called one thing on one policy, and it's perhaps called fund transfer fraud on another policy.
Yeah.
When do you think there'll be more standardization on a cyber policy?
I think we're still in the product's infancy in the grand scheme of things, and that differentiation is important to carriers, MGAs, Lloyd's facilities alike.
Right.
That's the reason I think that you see so many different names for so many different things.
Right.
It would benefit the industry, from my perspective, if we started to sort of coalesce around particular defined terms,
Right.
particular standards. I think that's starting to happen a little bit. Increasingly these policies are less oriented around schedules of 10 coverages and more oriented around that first party and third party basket that we talked about earlier. So that's taking place, but to your point, one carrier calls it social engineering, another one calls it fraudulently induced
Right.
transfer. It's still, rampant. But again, differentiation can be a good thing. It does make for a little bit of a complex buying decision, but I think that's where, if the insured is working with an agent or a broker who has real expertise or real depth in the space, that's where the agents and brokers bring value to the equation, is helping insureds navigate the differences between forms, or maybe in many cases the similarities between forms where they're doing the exact same thing. One guy just calls it something and somebody else calls it a little something different.
Right. So some of the other coverages that we rely on Great American for in the ESOP world is the directors and officers liability and the fiduciary liability. We're finding as brokers that there are many companies still that do not purchase cyber liability insurance. So what's the ramifications, do you think, with respect to the directors and officers of the fiduciary liability of an ESOP company not buying cyber liability insurance and having an event?
That's a good question. I mean, there are a lot of quality products and underwriters out there for cyber risk now. So it's increasingly available on very competitive terms and conditions. The scope of coverage is really considerable. And from my perspective, from where I sit, it's not a very difficult sell, right? We're giving a lot of coverage and covering some very severe claims for what we really think is fairly modest dollars.
Right.
So to the degree that an insured is reluctant to make that insurance purchase, I do think that a directors and officers liability policy could probably be implicated in terms of failure to effect and maintain insurance, right? It's probably not any different than if somebody represented a massive property risk and they were significantly underinsured, had a big fire, could only recover the limits of their policy, and that their losses were dwarfed by the limits of the policy, and now shareholders wind up having to bear that risk. Management probably didn't make a very good decision. Those claims have historically arrived on directors and officers liability insurance policies. I think that's probably the appropriate place for them.
Could it tag the fiduciary policy there?
It might. It probably could. I mean, I think it's primarily a D&O exposure, because the directors and officers are, kind of beholden to the protecting the company at large, right? The fiduciaries are protecting the plan and protecting the plan participants, and particularly in the ESOP world, I know there's a lot of that stuff overlaps. I think it's primarily D&O exposure at the end of the day, though. It's and it's something that many times carriers have included at different market cycles. Failure to effect and maintain insurance exclusion on a D&O policy, right? So to the degree you're not buying cyber, and you have a failure to effect and maintain insurance exclusion on your D&O policy, that's a situation I think you want to look out for. And again, that's where working with people who have considerable expertise in the space are going to recognize, those dynamics, whereas a mom and pop agent who doesn't often touch cyber or doesn't often touch D&O probably at a pretty significant disadvantage.
No, right. For our audience, can you kind of summarize what the underwriting process is before you provide a quotation or proposal for cyber insurance?
Sure. It's evolved over time, like anything in the cyber risk space. If you look at cyber insurance applications from 7 or 8 years ago, they're often 10 pages long, have 65 questions. A lot of them are very granular and want to pick up a tremendous amount of detail about people's network security infrastructure. I think the buyers, talk about headwinds back in the day. I don't think buyers were equipped to, or even wanted to complete those applications.
no. Right.
And the industry swung the other way, right? The pendulum went drastically in the other direction, and everybody came out with 2-page applications with only 16 questions on them. And it became a competition about who had less questions on their application. Well, when that happens, we can't make good risk selection. At that point, we're at a disadvantage, right? So the pendulum kind of swung too far. What's gone on, especially in the cyber risk world these days, is that vendors are kind of stepping in and helping us fill that void where we used to rely on the policyholder to give us a ton of information about their network security infrastructure. We're able to now get that information from a lot of different vendors that are in the space. So there are numerous large companies that have made multi-million-dollar investments in being able to provide network security information to the insurance industry so that we know what somebody's network security posture looks like. And many of us are buying those products and using them in our underwriting. So what's going on a lot of times these days is you're filling out an application that's maybe 20 some odd questions long, 20, 25 questions. Some of it's basic insurance stuff. What do you do? How much revenue have you got? That kind of thing. Others is a little bit more granular. And one of the questions almost everybody asks now is there a callback procedure for funds transfer, that kind of thing. So, you get these 25 question applications, and then we supplement that 25 questions with an array of data that we buy from third parties that tell us what type of operating system is somebody running? How is their email configured? Do they have a bunch of open ports on their network? And, so we go buy a lot of that information and help in the underwriting process make a good decision about risk.
And is there good engagement on the company side working with yourselves to offset any of those issues?
So engagement. So we offer these services, many of the underwriting tools that we work with, we offer them to our insureds, and if you want to avail yourselves of them, you can. We paid for it. We'll share the information with you. A lot of it's 24/7, 365 type of, monitoring. It's not as in-depth as you would get with if you license an intrusion detection system or anything like that. But it's valuable data we rely on in our underwriting. And so we make that available to our policyholders. Some of them, though, are already buying it. Some of them are already doing full-on network security assessments. Maybe they're in the healthcare arena, right? And they're going through regular and routine HIPAA audits and that sort of thing. But to the degree that we're asking them to kind of engage with our underwriting tools, we don't get a tremendous amount of engagement, unfortunately. I think people are interested in their insurance applications when they're going through their renewal process. After that, they don't really want to deal with, I wish they would, we wish that they would subscribe to a lot of these tools and that kind of thing, but oftentimes they don't. Engagement's pretty low. We do, though, we engage with the tools, right? So if I underwrite you on day one of your policy and we bind it up, you pay your premium, and the policy goes on the shelf. Everyone hopes that you don't have to use it. We're able to see, though, through our underwriting process, we're able to see continued data feed about your security posture. So to the degree something goes wrong, we probably can recognize it on our side. We get routine updates about our portfolio from our vendors, and so we oftentimes know when folks might be having an event. And on occasion, it's benefited us and the insured to reach out to the agent and say, you guys didn't subscribe to this service, we subscribed to it, looks like there might be a problem, might want to pick up the phone and ask the insured what's going on. And then, again, to your point earlier about how soon do you engage your insurer, well, we're involved on the front end then and can help out immediately. That's different than when the FBI tells you you're having a breach or something like that, and then it's infinitely more difficult. So while we use those services, we would encourage our insureds to engage with them. Oftentimes the engagement is pretty low. I mean, I will say that every underwriter is interested in insureds that are going the extra mile, doing the extra,
Right.
and, you know,
Right.
we know when you're engaged with the products. We can see it on our side. So that shows up in your pricing. That shows up in the underwriting. You know, there's definite merit to that. You know, companies that are more engaged and doing a better job pay lower premiums. And in the end, that's, I think, where everybody would like to get to, right?
Right.
You do the right thing, you pay a little bit less money, that's a win-win for everybody. So it's out there, but I think as an industry, we probably need to do a better job driving engagement in those tools so that we all do reap the value of that win-win.
Good. I think we have a couple minutes left. If there's any questions from the audience that want to be posed, please go right ahead. But I have, I guess, one last question for you, Ryan, is, I mean, from an insurance company standpoint, an underwriting standpoint, what keeps you up at night as far as whether a frequency or severity situation that you think could be happening next in the cyber world? Is it getting into transportation and breaches occurring there, or breaches within the government, or specific industries that maybe keep you up at night?
So from my perspective, it's aggregation. From where I sit, we have a lot of limits up, right? Every insurance company does. From where I sit, it's the aggregation exposure in cyber that's the most difficult to deal with, because traditional industries, you can underwrite around, you know, known events. Everybody knows where the windstorm areas are. Everybody knows where the earthquake risk resides, right? That's all quantifiable. All that information's out there. Nobody knows what the next windstorm in cyber even is yet, right? And these events, they don't respect the historical boundaries that other insurance products have always sort of enjoyed, right? So windstorm is centered in coastal areas, you know, you can charge more in coastal areas. Quake is centered around, you know, plate tectonics, you know, you can charge more in certain areas. Malware doesn't care if you're a doctor or Burger King, you know. Malware doesn't care if you're in California or Iowa. So we're not able to use a lot of the traditional catastrophe models that insurance companies historically have relied on, right? Concentration in industry, concentration in geography. Because these boundaries are kind of don't exist in the cyber insurance space, it's difficult to manage aggregation. There are also a lot of huge data centers and big providers out there that, if they had an event, would represent a significant problem for the insurance industry, right? If Amazon Web Services goes down, if there's, you know, if there were a number of different cloud service providers or you know, other institutions that had a major breach, the insurance industry would see that cascading catastrophic effect. But it's difficult to underwrite to, and because it doesn't respect class or geographic boundaries, it's hard to manage, you know. But we manage with traditional reinsurance purchases, traditional treaties, aggregation and stop loss strategies. Still use the same playbook, but it's very difficult to model and predict, you know, because it's in its infancies and because of these nuances in the coverage. So that's what keeps me as the carrier up at night, is the aggregation risk and what's going to cost us $100 million that we didn't even see coming. You know?
So you're really relying on the underwriting the particular account specifically, as opposed to, as you said, whether geographically or industry-wide. It's really just underwriting that specific risk and doing the best you can there to do that. But well, thank you. Appreciate the opportunity to talk to you, Ryan. And for the folks at home, if you have any questions with respect to whether it's directors and officers, fiduciary, or cyber insurance, feel free to reach out to Patrick or myself at Murray Insurance. Thank you.
Thank you.